Welcome to the Market Huddle Plus, episode 42. I'm Patrick Ceresna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome back to the show Tavi Costa, macro strategist at Crescat Capital. Tavi, great to have you back on the show. The last time you were on the show back in December, we took a deep dive into precious metals with gold today closing at an all-time new high. It's a great time to get an update from you. What's going on with gold?
Yeah, look, I last time I was here, I was really perplexed by the idea of how popular the focus on T-bills and chill, when I thought gold was on the really on the verge of a major breakout. Now we've been up about four or $500 literally on the gold price since that time, and it's maybe time to T-bill and chill, but that doesn't change my opinion in gold at all. I still, as a structural view on the metal, and knowing what's been happening in regards to not only the gold bug view but also the macro view, has been really supportive of gold. And who would have thought that we would be seeing such a gold rush across most central banks? And that has been confirmed for disclosed data. Who knows how much is happening undisclosedly, which is probably an even bigger deal, because if we calculate how much of the move has been happening in gold, I don't think the disclosed amount of purchases really explain it. So that is an important aspect of this idea. And then on top of it, we continue to see ETFs is still not really following. So the retailers are still sitting on the sidelines, which is a little bit shocking. I think that's great news, because that just shows that how early we are. Usually retailers tend to be the last ones to party, and so this is not even the institutions outside of central banks have really started to accumulate. I mean, the term 60/40 portfolios is still the case, and a lot of people still continue to have very low amounts of allocation towards gold. I think I showed a family office allocation of gold not too long ago, in which was less than 1%. I think it was 0.8%. And the commodities was less than, I believe it was less than 2%, which is astonishing low relative to history as well. So, things continue to be very asymmetric, if that's the word, from a lack of allocation and capital interest. And what reminds me this is what I guess a phrase from Senzel that I love. Rest in peace, Senzel. That he was such a brilliant mind. I had the chance to meet with him actually. And once he said, "Great money is made on where there's lack of capital interest, and not the other way around." And I take that to heart. I do think that the mining industry, not only the gold space, remains where that's still the case, where we continue to really lack capital to make things more efficiently. And that's really where the opportunity lies ahead, in my view. There is a sort of a conventional thought out there, that is important to point out, where everybody thinks that the gold space and the metals will continue to, it's okay, that makes sense that they are rising, but the mining industry will not follow. And that's one of the most historically unsupported views I've seen in my career. So, I stand very much against that view. So that's basically the 2 cents on everything that is going on.
What was interesting was just a few months ago, maybe it was a little bit more than a few months ago, but there was a huge push on both X and on many podcasts where there were a couple of these pundits coming on basically saying that why would you ever own a mining company when you could own the real gold? And they were just like shitting on the miners in the most spectacular way, showing, the 20-year return history of these miners and how it's the worst investment ever. And I thought to myself, like, could that be not the most contrarian, opportunity when they're talking this way, that it just shows just how depressed the pricing is in that mining space and what the opportunity is. Now, in your mind, is the opportunity in the precious metals, or do you think the miners themselves are where the alpha is?
The alpha is in the miners, without a doubt. And in my opinion, and we can go on in different verdicts here. I'll start with, there's a really interesting chart. If you look at the gold price from 1980s, all the way to, I think it's 2001. In fact, April 2001, you're going to see gold was down about 70%. Can you imagine trying to support a bullish thesis in the macro side that gold was going to go on and basically have a 9x in the following years? Basically impossible. There's, no kidding, people were calling it a pet rock and so other things as well. Today it's exactly the same thing, but with the miners. Now, if you look at the chart of the miners, 20 years of underperformance. Who in the right minds wants to launch a fund to invest in the space? That sounds like one of the stupidest ideas you can think of. Well, I did. So, um, but then here's a really interesting factor that really blows my mind. Um, Mining has been in this space as probably one of the longest businesses in history that we have, that is part of our society. And I was looking at the private fixed investment, which is in the mining industry relative to GDP. Back in the 60s, this indicator was about basically mining was accounted for close to 20% of GDP. This is not a joke, 20%. Any
Wow.
guesses what it is today? Just for curiosity. Yeah,
Less than 1%.
it's 0.3%. So, one can maybe explain this, that part of it. Good guess, by the way. Um, One can maybe explain this by saying, capital efficiency, labor efficiency, and that's fine. I don't disagree. I think there has been a lot of technological advancements that cause, that to become a more efficient part of the market. But the big explanation, in my view, to cause something to go from 20% of an economy to 0.3% is globalization, actually. And if we look at the amount of metals that we use, that really hasn't changed much. And in fact, the amount of that has been imported recently and how much we depend on imports of metals and ore in general has been much more than we've seen in the past. It would not surprise me to see in the next coming decade mining becoming a critical part of the economy again. And that by no means I think we'll go back to 20% or anything like that. And it could, but I do think that 0.3% is basically a margin error, and I don't think that also is appropriate. So, no, those are that's a very important thing. And the other question would be, why are the miners really lagging? No, I'm in basically in the forefront of looking at mining stocks and really mining projects, especially privately now, because there's so many opportunities on the private side. One thing that I've been sort of seeing across, which it's been the case for a while now, and it shows the kind of excessively aggressive, or I should say conservative approach of this industry now because of the lack of capital. You look at a mine that is being sold today. First of all, they're going to basically present to you the future cash flows that they expect, by looking at how much ore there is and then looking at how much production will be coming over the next decade or so for that project specifically. The assumptions they make are the following: massive inflation on cost. I guess if that could be the case, and massive deflation on metal prices. I don't know who's got the right mind on the macro side here, but I can't come up with a thesis, in my opinion, with a high probability that will be the case here. And I think it's going to be
Hmm.
maybe high metal prices with some inflation, but maybe there is a case that we can efficiently mine or and become a lot more profitable as an industry. Looking back in the 70s and the 40s, and the fundamentals of most of the mining companies, boy, they were cash flow machines. I mean, who would have thought, for instance, that the oil industry would be a cash flow machine? And there we are. So that could be the case with the mining industry as well. And I think a lot of people are dismissing that type of change, of potential change, which is the main thing that really affects price at the end of the day. It's the potential change in bottom line, which I think that the industry of mining is essentially poised for some significant ones. I mean, I can speak for some of the projects that we look at, in which you can spend close to 10, $15 million of capital to improve your free cash flow on an annual basis, close to 100 million a year. I mean, I don't know of many industries that are able to see that type of change, and most of that is on the back of total lack of capital, but really interest and time being spent on thinking how to improve a business. And a lot of people are leaving this industry. So there's a lot to be done. But those are the things that really, to answer your question, that I think offer
Yeah.
a tremendous amount of alpha. And those that really understand this industry are going to be in high demand.
Well, it's interesting because when you look back to the great financial crisis when the gold miners bottomed out there, obviously had a devastating drop during that period. They proceeded into the 2011 period to like using just like the main GDX ETF, proceeded to go like 300% from trough to peak on the upside in a span of 3 years. And there was huge money being thrown at the miners to start new projects and put all sorts of things in play. And obviously, there was a massive gutting of that entire industry over the following decade. And a lot of people, sit back and say, well, that's evidence of the fact that it was such a bad investment. But I think it was just a sign of the times. But really, we haven't seen any interest in capital expenditures or putting more mines to work or putting or drawing more gold out. Like, does that in your mind kind of suggest that we're still very early in the stages of this cycle? Like, if you were using a baseball analogy, like what inning do you think we are in a mining cycle for the precious metals?
Well, I think the game hasn't even started yet, right? I mean, we're still in the other game at the end of it.
Yeah.
It's been brutal. It's been absolutely, a total. I guess, I mean, I haven't seen an industry suffer for so long, and especially the labor side of it. I mean, we've been working with different schools trying to bring the attention back with students from other countries potentially interested in learning about geology, because I think it's going to be in such a high demand. But if you just think, Patrick, from a generalist standpoint, if you're just looking at companies like I was mentioning and looking at just the future cash flows, which are such an important aspect to really, I guess, come up with a discounted mechanism of what something is worth. And when you're looking at prices, if I tell you that most of the mining companies are using still 18, 1600 sometimes prices for their future cash flow analysis, would that stun you? But that's the case.
Yeah.
That's literally the case. I mean, one of the projects we were looking at, there's something called the sensitivity analysis on resources. So basically, just to give you a sense of what I'm talking about, the higher the price, essentially it lowers the cutoff of a production, which makes me, which essentially what it causes is that those that the ore that wasn't economic because of the higher prices becomes economic, so increases the resource amount.
Right.
And therefore, you have to look at those assumptions when you're buying a mine. What is the price that you're establishing in order to come up with a resource, essentially? And nobody looks at those things, especially in the and a general investor. The people in the mining industry, yeah, of course they look at those things. That I'm not saying anything new, but majority of the analysts that don't really look at those things closely, they have no idea about that. And the leverage we get on gold prices increasing in terms of production is absolutely crazy. I mean, some of these mines are being sold with 8 years of mine life that essentially have at least tripled that amount, and depending on the gold environment you may see. And you can throw those numbers into a sensitivity analysis and it will shock you. And so that's the type of stuff that I'm really interested in, because I think it's almost like an arbitrage. They're
Yeah.
being sold as they're going to see massive inflation and deflation on the price, and so the price, the present value being sold of that company is being essentially reflected by those assumptions too. And so it's remarkable. I don't know of any other. If you just for a comparison do that with the technology space, it's the complete opposite, right? Costs will never go higher, and supposedly, and the cost of their service will also never go lower. It's always the consideration that things will be incredible in the future, and that's usually the case of excessive capital chasing a sector. that it becomes incredibly efficient as well in terms of pricing. And so there is no arbitrage. It's very difficult to really find great opportunities. Great money it will be very difficult to be made in those parts of the economy in the next 5 to 10 years, in my view. So the mining space is to me a very very early innings. Another thing you can point to is definitely the M&A cycle. We're starting to see M&A across the major companies, so majors merging with other majors. And that's really on the back of the fact that they also face a supply cliff. So by buying another major and merging, essentially they increase the mine life of their overall company. And so that's an easy way to fix the problem. But still, the overall reserves that we have out there that can be mined have not really increased. We just
Yeah.
switch hands of
Just
who
who
owns
owns it?
them.
Yeah.
And so those are the most relevant things going on. It's still really early, and I think there's a lot of things to be done here in all parts of the industry.
Now, usually, the if there's a huge turn up in the cycle, it's obviously the greatest leverage comes from the juniors, the ones that are still off the grid, like no one knows about them and things like that. But do you think at this stage it's still safer to stay with the more established companies, or are you already suggesting people allocate to some of those juniors and up and coming startups?
Well, I think it's the easiest way to answer that question. It requires to either have a network of geologists or understanding the industry very well, which very few people do. And the lower you go in terms of market cap and size, obviously the higher the risk, and also obviously higher the inefficiency, which could be seen as opportunity. And so, yes, I mean, we navigate in a junior micro cap kind of space right now because today I'll give you a few examples. You and the we usually say you've got exploration, development, and production, and the royalties. The royalty companies have done fairly well actually because of their they have leverage to gold prices, but not a lot of issues with cost increases. As long as the mine continues to produce, they can collect their royalties, and that's why royalty companies have done well. But they also have become a lot less efficient because most of the capital that has chased the mining industry, which has been very small, have gone to that portion of the industry. The production side, most of the financially savvy folks will be able to navigate that because it's just a cash flow calculation. The development side becomes more of an engineering mixed with geology and mixed with financial analysis. And so it becomes a little less efficient and certainly has room for folks that like to do fundamental and value investing approach will probably fit into that part of the industry very well. Now, the exploration side requires a tremendous amount of knowledge on geology. And I have to rely on Quinton Henney, which is probably the smartest guy I know in the geology side when it comes to exploration, and that's why I've been working so closely with him. But there's once we figured out that we can also own production assets and add the leverage of our knowledge on exploration to increase the potential for growth, that probably is a sweet spot. But there's plenty of companies in the exploration side which is incredibly risky, but also rewarding. If you,
Yeah.
most of the billionaires in this industry have made their money in exploration, if not all of them. And you can name any of them, and majority of them actually made their most of their capital on buying a company at its very early stages, if not buying the property outright, and then finding a major discovery and becoming a billionaire on the back of those discoveries. So it can be incredibly rewarding. And so we've been taking more of a venture capital approach where we invest in a bunch of exploration stores. And if one or two or three, meaning a few of them actually work out, obviously we want all of them to work out, but that's certainly not the case. And, it pays off for your other losses. And so that has been the way we've been navigating this. And the key here is that there's a few types of exploration stories. If you go really early at the very junior side of the mining industry, you're going to find that the very small cap companies that are only exploration companies, they have sometimes drilled those projects already, and have already found a lot of evidence that they have a discovery. Not to go deeper into what those evidence will look like, but
Yeah.
which we could talk about it, but some of them already found something, and the price still reflects as of if they haven't found anything. So those are the ones that I find really attractive, because they're basically being sold at the same price of a company that hasn't drilled yet, or certainly carries much higher risk when it comes to execution. And so that's I think that there's a lot of opportunities in that side of it, and I do think that the fact that we don't have a lot of most of the majors facing this reserve cliff issue. In other words, that they're running out of ore to produce, will eventually force them either to explore themselves, or to start looking for companies that have found already strong evidence of major discoveries. And I think that engagement of the majors with the very micro businesses in the space have already started, and we're seeing that in our own portfolio. And I think that that's just the early stages of an M&A cycle that will probably be even longer than the usual.
All right. Well, listen, I want to move on and pick your brain about this economy. Increasingly, there's a large amount of analysts out there falling into the no landing, soft landing camp. Did the global economy avert a recession? Where do you stand?
I think it's more of a sentiment game. We came into 2021 with things looking very frothy. The market finally came back to normal on the back of mostly the tightening of cycle of the Fed, and the transition from growth to value at that time as well. And then followed by the Russian invasion issue, which caused inflation to go even higher at that point. And those things I think really scared the market. And then sentiment shifted from being extremely bullish to then extremely bearish. We had 7 cuts priced in, and everyone and their mother was saying that you should T-bill and chill, and then guess what? That's not exactly what happened. We had a bunch of other assets that made your 5% on T-bills or 4.5% looked like a terrible investment at that time, especially seeing gold having a move like it did. And so, or silver, or, in other metals, and copper as well, in particular. And so, where am I now? I think that there's a lot of complacency, and that's really being shown in the volatility suppression that we're seeing, the lack of folks pricing in the chances of financial stress in the system. And that's the leadership is changing. What's interesting here is that a lot of people are seeing this rotation of small caps, away from the large caps. And I'm talking about in the last
Mm,
days here with
yeah,
the surge
this
in
week.
Russell 2000 and others. But in a different way, back in the early 2000s when we had the tech bubble, there was a broadening of the market, not in small caps, but equal weighted, and that wasn't a good sign either. So I tend to not be very to really depend on that as my as a bullish view to change my opinion. I've been bearish in this economy. I think there's much better things to be doing risk wise than investing in technology. And I think ultimately we're going to go back to a world where to this rotation would actually occur, where we start really prioritizing value over growth, and emerging markets will probably see a resurgence as well. So I've been paying close attention to that, and I do think that the 2-year yield looks really attractive here. Meaning, I do think that it could have a lot lower. I think the Fed is the dominance on the fiscal side of the Fed of the U.S. itself is completely unsustainable, given the fact that it's now close to 4% of GDP to
Mm,
service the debt, which is the highest across any other country. And that will ultimately bite the U.S. in terms of having to do more, not less, when it comes to easing policies. And I think that's going to have an impact in FX, but also growth in the U.S. because it's going to cause that fiscal dominance is completely unsustainable in my view.
Right. So moving on to that, I wanted to kind of dig deeper into this bond trade. Obviously, you were referencing the 2-year bond. Now, when we look back at the bear market of 2022, where the stock market was down 20+% off of its highs, to me that was really a bond bear market, and
Mm.
that was a period where the bonds failed to be a defensive asset. And literally, there was a repricing of all risk assets, and it was quite a traumatic event for many 60/40 portfolios. So, I mean, at this stage, a lot of people have entered this bond bear camp, where they think that we're on a secular basis. Bonds are just going to be a really poor investment. In your mind, is the 60/40 portfolio dead, or will we have a period where these bonds will still play a role in a portfolio and potentially act even as a defensive asset during difficult periods?
Well, I've been of the view this is a different macro regime since what we saw in terms of the policy response from the COVID and the pandemic recession. I believe that things have changed in terms of the behavior of asset classes, and perhaps bond will always the bond market, the fixed income market will always have its role in financial markets, and there's no doubt about that. I don't want to sound like that's not the case, but I also think that 40% of a portfolio on fixed income securities seems to be a bit extreme when you have other things, especially real assets, that have been neglected for so long, that could potentially fit into a portfolio and very nicely, especially in a more inflationary environment. When I say inflationary environment, I'm not talking about 10% inflation rates. I'm just saying inflation staying higher than historical standards, which certainly has been the case in the last years relative to the last decade, in the last 2 decades, I should say. So, I've been worried about the bond market from a supply standpoint. I think the market has catched on to that quite a lot. I think that also there is the biggest trade to me in the bond market right now is the steepener. We've had a steepener trade for the last maybe month or so in our fund, and especially in a day like today that is actually working the other way. I think it's an interesting setup to be adding to that trade right now. So we've been very focused on the steepener trade as a way to do this. But answering your question, I think that ultimately institutions follow large central banks. When central banks used to own not a lot of gold in their balance sheet, and back in the 70s, they went through an accumulation process of gold. And they end up peaking at around 75% of the balance sheet assets was basically gold. That also happened because of the appreciation of gold itself, but
Yeah.
there was a major amount of accumulation happening in that decade. And after that, uh, central banks are starting to basically finance each other's fiscal stimulus and started to buy each other's sovereign debt. And so we had a period of over 20, 30 years of ECB buying treasuries, the BOJ buying treasuries, and also European assets, and so forth. And so we've had this exchange by central banks buying each other's sovereign debt for a long time. Um, and I think that had a major impact on this declining interest rates environment we had over the last 2 to 3 decades. Now I think we're kind of in the end of that era, and I think the central banks is starting to really try to increase their allocation in gold. Not to, maybe I'm not sure it will go back to 75%, but certainly won't be below 20%, which is it is currently. And ultimately, those institutions that have 60/40 portfolios and so forth that follow the same pattern of those central banks accumulating sovereign debt, they did the same. That was the creation of the risk parity and the 60/40 portfolios. And this time, I think will be the other way around. We're going to see more of a diversified, allocation in which we'll have gold as a defensive asset, but also other commodities being part of that as well.
Yeah.
And emerging markets, the fact, even if you look at the 60% allocation in equities, is so focused in US companies that I think will not be the case in 10 years from now. I think we'll be a lot more diversified into other countries as well, especially because this fiscal dominance issue that I said that is particular with the US is very unsustainable in my view. And that's going to have reflect on growth as well. So that's really the opinion here. I think there's going to be a lot of changes in that, and if that's the case, things are not priced in accordingly, and there will be a lot of changes in repricing of valuation of assets and companies on the back of that.
All right, Tavi. Before I let you go, though, I wanted to just pick your brain on this AI bubble, or is it a bubble? Like, what's your take on how this is played out, and what do you think? How do you think it plays out in the end?
Well, Patrick, I'm not a technologist and an expert in the space. However, I'm disciplined in terms of what I see throughout history. And when I hear folks that have no idea where, it's the same goes for gold, right? It's like hearing people talk about gold with no knowledge on geology. It's like it just hurts me, but I see that all the time. And the same goes for technology right now as well. And I'm not here to say gold is overpriced, but I see this happen all the time in the macro world. But it's interesting because it feels like we've seen some dominoes falling recently, right? There's some
Yeah.
changes, like we said, like the Japanese yen used to be a safe haven, it's no longer that. Treasuries used to be safe haven, no longer that. And those things are, and we had oil companies used to lose money all the time. Well, maybe they're starting to become cash flow machines and things like. So there has been some very meaningful changes in the environment, and some parts of that have not really been reflecting this environment just yet. Meaning, some parts of the market are still living in a low interest rate world, and to me that's volatility, to me that's credit spreads, to me that's technology, and that's not the world we're living in. We have rates a lot higher. To me, corporate rates are poised to go a lot higher because of where rates are. That's just estimates of investors thinking that rates are unsustainably high. But we're in the world that maybe rates need to be higher than 0%. And if that's the case, a lot of things need to be repriced, particularly risk. And I can't
Yeah.
think of risk increasing and not seeing that really also impact technology companies' valuations that have been so extreme. So, I definitely am on the bubble side. If that's your question, I'm very cautious about this. I own zero technology companies, and I'm happy to be on the sidelines and focus on things that I think are a lot more. They're truly inefficient. That can really create wealth in this coming decade.
Perfect. Well, Tavi, if people wanted to learn more about you and where to follow you, where can they find you?
They can find me on Twitter at Tavi Costa and also on crescat.net, where we write our letters and information about what we do. But thanks again, Patrick. It's always a pleasure speaking with you, man.
Well, Tavi, great to have you back on the show, bud.
Thank you.
Thank you for tuning into the Market Huddle Plus. We'll be back next week with another episode. Cheers, everyone.